On the flip side, if you're a little hands-on, you're okay doing index investing on your own, you're okay purchasing bonds on your own, you're okay creating that list of stocks on your own, then keep your mutual fund portfolio very, very small to begin with. Hi everyone, welcome to today's video. So let me start today's video by telling you a very fascinating story from the stock market about a family called as Gottschalk's family. Mr. Warren Buffett has also narrated this story back in his 2005-2006 shareholder meeting. There are very, very important lessons here. So I will spend a minute or two just telling the story. So the story goes something like this, that once upon a time in the US, there was a very rich family called as the Gottschalk's family. It had a lot of members. There were a lot of members, 60, 70 members, and they were like filthy rich. They used to own the stocks of all the listed companies in the US, and because they were owning, in technical terms, an index, every year their wealth used to grow because the US economy was growing. And because Gottschalk's family was owning all the listed companies' stocks, their wealth was also growing. So everything was good, everything was cheerful. Then a few years passed, a few of the family members, a few greedy ones, they started getting jealous of each other. So this is a very common scene in India also, that rishtedars also get jealous with each other. So same thing happened with the Gottschalk's family. And a few greedy members thought that, you know what, if we have to make more money than our cousins and all our other rishtedar, then we have to go and hire an investment advisor who will guide us on how to make more returns than all these other different people from our family. So they went ahead and hired a financial advisor. Now, few years passed, all these greedy family members who had hired a financial advisor, they saw a very interesting observation that with each passing year, their wealth was actually going down rather than increasing. Now, this phenomena has been wonderfully captured by Mr. Warren Buffett in one of his quotes, and it goes something like this, that when the motion in the stock market or the activity in the stock market increases, your wealth goes down. Why does that happen? Think about it. There are very important lessons here. So the reason number one is that when you hire a financial advisor, then you would have to pay them commissions. So that gets into it. Your financial advisor might trade stocks on your behalf. So every time he or she buys or sells a security, then you will have to pay taxes to the government, GTT, STT, whatnot. There might be performance fees also. So the bottom line is that more activity that is done in the stock market, the more your portfolio shrinks. This is a very important lesson, especially for salaried employees, especially for newcomers in the stock market who think that everyone is making money. So let me buy like more stocks and let me keep on trading it. Let me do day trading also. Let me do like swing also. Let me do like futures and options also. If you keep on doing everything, you are not going to make money in anything. That is the simple message that Mr. Warren Buffett was trying to give through this story. Now, how does this apply to us? This applies to us in a very concrete way, because if we are making a salary of, let's say, 50,000 rupees and we don't know enough about investing, then we end up doing really fancy stuff. For example, we will go and buy random stocks, or we will go and invest in like 50 different mutual funds. And that is not a good practice. So please listen to this video very carefully. It's a very important video. I will explain it in a very easy to understand language through 5 simple steps, what you should be doing with a salary of 50,000 rupees, how to invest it, especially when you don't know much about stock markets. Share it with your friends also, and do press the like button. Also, a very quick shout out to our sponsors for today, which is Golden Pie. It's an excellent bond investing platform where retail investors can buy bonds on a commission-free basis. So let us start discussing those 5 points. Point number 1 is that if you are getting a salary of, let's say, 50,000 rupees, and if you don't know much about stock market, then you should invest 20% of that money in the bond market. Now, I have done a separate video on bond investing, so you can go and check it here. But there are 3 very important points that I would like to outline about bond investing. So first and foremost, bond investing is much safer than equity investing. But depending on the type of bond that you are purchasing, it could be riskier than a fixed deposit. So the risk curves look something like this, that you have FD, which is least risky, then bonds, then equities. So this is the simple underplay. Now the returns are also opposite, that equities are likely to give you the highest return, but the risk is also very high. Now in terms of returns, equities are likely to give you the highest amount of return if you know how to invest in equities. If you don't know, and if you're just going and experimenting, then yeah, that's a really bad idea. Then it's better that you invest slightly more portion in the bond market or the other subsequent options that I'll be speaking about in this video. Now, another key point that you need to remember is that majority of the bonds also give you higher return than fixed deposits. Now, fixed deposit is also a type of a bond, but the problem with fixed deposits right now is that the FD rate right now is hovering around 5.5%. Inflation in India is going to be between 6 to 8%. So typically you will be losing roughly 2.5-3% 20% of your entire money in a one single year by investing in fixed deposit. So please don't invest a lot of money in fixed deposits. Second key point that you must understand about the bond market is that there are two options that you have in order to invest in the bond market. Number one is that you can go and purchase a mutual fund, which is called as debt mutual fund. Now the problem here is that the mutual fund manager is going to charge commission. They are going to trade securities at the back end. Again, they will have to pay taxes, commissions, whatnot. So again, going back to that Gotrock's family story, that your overall returns will be eaten up a lot by commissions and trading and other charges. Now there is a direct way. You can go directly to Golden Pi's platform and you can go on this Discover Bonds tab. Now on the left hand side, you can use these different filters that, hey, I want to earn like higher fixed income, then fixed deposit. I want to invest in AAA securities, etc., etc. You can use filter, and whichever bonds come on that list, you can go and invest in it. Now, for example, hypothetically speaking, if you filter this criteria, again, I had made a separate video on Golden Pi, so you can go and watch it. So let's imagine that you end up reaching the South Indian Bank Limited. So here you will see that the minimum investment is 2.05 lakh. So let's say that your salary is 1 lakh rupees. There is a lot of kharcha, etc., etc., and you are left with 50,000 investable amount. So you take 20% of that 50,000, which can be earmarked as bond investing money. So that gives you how much money? 10,000 rupees. So 10,000 rupees you start saving on month basis. You do it for 20 months and then you go and purchase a bond like this. So this is your first option. Meanwhile, what will you do with that money? Meanwhile, you can put it in liquid debt fund. So just Google what liquid debt funds are and you can put your money there. So that is not a problem at all. And this is how you can invest in this option number one. Now, how much investment amount will I recommend to you? So I will say that invest 20% of your investment amount in bonds. So for example, if your salary is 1 lakh and you're saving 50,000, that is your investable amount, then invest 20% of 50,000, which is 10,000 rupee in bond on a monthly basis. Now then comes option 2, which is index investing. Now why do I propose index investing and what precisely is index investing? Very quick basics there. That index investing is that you simply go and buy something like Nifty 50 or Sensex. These are mutual funds. Now you'll say, Akshat, you just said that don't invest in mutual funds. But yes, that passive index mutual funds, they have very, very less commission or the least commission possible. You are not losing out insane amount of money in commissions. So these are least commission oriented products per se in the mutual fund industry. So you simply go and purchase what? Nifty 50 or Sensex. Now, what is the benefit of index fund investing? It's very simple. So let us quickly understand it. This is the entire Nifty chart in front of you. And here what you're doing is that every month when you get a salary, you take out how much money? You take out 30% of your money and you put it here, right? So 50,000 was your investable amount. How much money will you take out? You will take out 15,000 and every month you are going to invest. So you keep on investing. Every red dot means 15,000 and you are investing, right? Then what will happen is that you will end up getting like an average return, right? So this is the trend that your returns will follow. This is a simple system that every month pick a random date. For example, pick 13th of every month. Why 13th of every month? I'll tell you the logic also. So pick 13th of every month and keep on investing this 15,000 on every month basis, whether the market is going down, whether the market is going back up, because in the long run, Nifty always cuts its previous peak. So your average returns will be higher, no doubt about that. As the economy of India grows, your money will keep on growing with it. Now you will say, Akshat, this looks like such a genius idea that, hey, index always goes up. I will put my money. Then why are you recommending that I put only 30% of my money? Why not 100% of my money? Okay. The answer there is very simple, that index investing is not foolproof investing. Why? Because there are periods when the index does not give you much returns. So let me show that also. For example, if you started investing somewhere in 2010, right, then the index was at 5,884. Then till 2014 approximately, the index did not give much return. So you will get frustrated that, hey, 4-year period, I'm not making any return. That Akshat gave me wrong advice. Unsubscribe from his channel and move on. So I'm telling you very, very honestly that it's not as if that index investing is foolproof. There are periods when index investing will not give you any return. And that is the time when you specially have to control your psychology and keep on investing. Because in the long term, index will go up. No problem there. Therefore, I'm recommending 30% in index investing, 20% in bonds. Because the bonds bonds that you purchase from Golden Pie, it will definitely give you returns. So at least these two things balances things out, and at least you will feel that I'm getting some return. Now comes the last part of index investing, that why did I suggest 13? Because there is an index management game that happens. Even mutual fund managers who keep on moving Nifty, how they do it, that's a separate discussion altogether. But mutual fund managers, big investors, they understand that when you are getting your salary, you will jump to invest it. So usually everyone invests their salary in the first 10-12 days of the month. 13th is considered to be unlucky in several cultures. So you go and do it on an odd day that no one is doing. So that day the market is not going to be severely manipulated from that sense. But keep on doing it on 13th or any random date that you pick. That will give you returns, but don't do it in the first week of the month. That is my simple advice. Now comes option 3, that you will say that Akshat, you know what? We want to be direct stock investors. At least we will start learning something. That is very important for us. And eventually people make a lot of money in the stock market. So how will we learn it if we are not trying it? So I agree. So this is how you get started. First and foremost, start with only 20 to 25% of your entire investable amount. So in that 50,000 rupee that you have to invest, do not invest in the market. 25% of that money directly in stocks, especially when you're starting out. So 25% of 50,000 is 12,500. So that is the amount of money that you should be investing in the market every single month. So what you do is that you create a list of stocks and you do SIP in them. So for example, if your list of stock tells you these 5 stocks, then every month go and purchase these 5 stocks in an SIP format, that every month, no matter what happens, whether the stock is going up or down, I'm still going to purchase it. So you just do it. That is where you start, and that is how you spend your first year in the stock market. This is very important. Please do it. Please try it out. You will learn a lot about stock market investing from that particular perspective. Now, how to create a stock list and what are some basic points to remember? There are 2 key criteria that a stock should meet in order to get featured in your list. Criteria number 1, that your stock, whichever stock you are purchasing, it should be a profitable company. So let me show this to you by taking you to Screener. So here is Page Industries, and let us look at its balance sheet, profit and loss statements. So you can see that, hey, the sales of the company is growing consistently. Net profits are also growing. So try to pick this simple type of company. That's one. Second, you must understand how the company is going to grow in the future. And where will you find this data? Just go and read the annual report. If you are convinced after reading the annual report that, okay, this company has growth prospects, if these 2 simple criteria meet your list, please go and purchase that stock. At least you will not lose your capital. Now comes option 4 and option 5. This is for people who cannot do the first 3 things. You think that, you know what, I'm just too busy with my job. I do not have time to invest my salary. I just don't find the time. What can I do? I have like 9 a.m. to 11 p.m. job. There is nothing I can do. I can't track the market. It is just too cumbersome for me to go and invest things on my own. So I want to give my money to someone to manage. It's fine. I understand it. So what are your 2 options there? So option number 1 here is mutual fund, that if you don't want to do things on your own, go and invest via mutual funds. Now please remember that try not to buy hybrid mutual funds. Why? Because the commissions generally on hybrid mutual funds are very, very high. So you will end up losing a lot of commissions. It's better to invest in passive funds, but if you don't even have the time to do that, it's okay to just buy large cap blue chip equity funds. Just buy that and be done with it. Now the problem that you will face in terms of investing via mutual funds is that you would not know what exact securities are being purchased at the back end. That brings you to a related option, which is called as small case investing. So here there is thematic investments that you can make. For example, if you're very bullish about the rural economy, then you can go and buy a small case which is focused on rural economy. So this way you are at least understanding something before investing in it. But yes, you don't need to manage that portfolio at all. Someone is going to manage that for you. Now, how much money to invest in mutual fund or small cases? It really depends on how much time you have. If you have absolute 0 time, then invest all your money via mutual fund and small cases. It is fine. You are done. You don't have to keep tracking it. The mutual fund manager or the small case manager is going to send you the updates, and you are done, and you don't have to worry about it. On the flip side, if you're a little hands-on, you're okay doing index investing on your own, you're okay purchasing bonds on your own, you're okay creating that list of stocks on your own, then keep your mutual fund portfolio very, very small to begin with. Then comes the final option, that I'm a super busy professional. I have no time whatsoever, and I don't care about commission. I don't care about other things, but I still want to make high returns without knowing anything about the market. Then you must try something called as portfolio management service, PMS service. Now there are big investors like Mr. Saurabh Mukherjee, who runs Marcellus, which is a PMS service. So you can go and check out these type of forums and other fund managers, whosever investing style you like, give them a large chunk of your money and they will invest your money on your behalf. Now, what are the pros and cons here? Now, essentially, PMS services are very, very expensive from a commissions point of view. For example, here are some of the leading PMS services in India, and this is their associated commission. So 2 to 3% commissions is very, very high. Plus, there is performance fee also. So essentially, this becomes like a very expensive affair. This is problem number one. Now, problem number two is that usually these PMS services have a very high ticket size. That again becomes a problem for majority of the retail investors, that you need a minimum ticket size of roughly 50 lakh rupees to start with. So this becomes an expensive affair. But yes, if you're a salaried professional who is making crazy amount of money, and if you have a lot of money aggregated with you and you have zero time to invest in the stock market, then PMS service might make sense for you. So just a very quick summary about the entire thing, that number one, please remember the Got Rocks family story. Very, very important. Your idea, especially as a small retail investor, should be to decrease the motion or activity in the stock market. Pick things where you don't have to pay a lot of commission. For example, if you're buying bonds, go buy via Golden Pie. It's a good platform, commissions free platform. Similarly, if you're buying index funds, the commissions are very low. So your job should be to lower the commissions. Number two, try to do things on your own. If you do it, then you will end up saving a lot of money in terms of commissions. But if you see no other option, you are too busy, then there are services that you can explore depending on how much time you can invest in the market. But I hope that this video gave you a sense as to how to go about investing your salary and what are some of the basic, absolute basic things to keep in mind. Please press the like button, share it with your friends, and I will see you tomorrow.